I think people are finally starting to realize that the stock market doesn't always go up. And what's really kind of frightening today is that when the market goes up, people start selling, not buying. Now, that may not mean much to you, but for those of you who bought the BS or that drank the Kool-Aid that invest for the long term, this is your program. Because if you're really an adult, you already know that markets go up and markets come down. And what makes the Rich Dad radio show and the Rich Dad company different is that we really don't care which way it goes, because you can actually make more money and make it faster when markets come down. Now, unfortunately, most people who drank the Kool-Aid bought that BS that, well, invest for the long term in a well-diversified portfolio of stocks, bonds, mutual funds, and ETFs. And right now there's people holding their butt because they're hoping that the markets are going to go up. And again, the philosophy of Rich Dad is that who cares which way it goes? In fact, it's actually better when it comes down. So today we have a very special guest. He's been on our program before, Dr. Alexander Elder. Dr. Elder is a legend throughout the world. I first came across his work in the 1990s out in Sydney, Australia. And Dr. Elder has his cult following in Sydney, Europe, as well as Asia, because he teaches people about trading. His first book, Trading for a Living, which came out in 1993, and his latest book is Come Into My Trading Room. And trading is very different than the mantra of invest for the long term in a well-diversified portfolio of stocks, bonds, and mutual funds, and ETFs. So today you're going to hear the contrast for those of you who drank the Kool-Aid and bought the idea of what they call going long. Going long means you're going to just stick it out. It's happy days are here again. And today Dr. L is going to talk to you what a professional trader is. So this is the point of today's program. There are passive investors, and 98% of all investors are passive. They invest in stocks, bonds, mutual funds, and ETFs. And then there are professional or proactive investors. So today, I want you to stay tuned because you'll hear from a professional investor, Dr. Elder. Like I said, he's a legend all over the world, of the difference between passive investors and professional investors. Any comments, Kim?
Well, I'm excited to talk to Dr. Elder because I'm reading the paper yesterday, and one article says, oh, don't worry, the market is rebounding. It's going to be stronger than ever. And then the other article says, no, the crash is coming. It's right around the corner. Everybody get out. So I'm happy to have Dr. Elder here, and I'm happy to talk about our philosophy, because if the markets go up, you make money. If the markets go down, you can make money if you've got the financial education to do so, and that's what Dr. Elder is going to give us today. He's also very, very much involved in the psychology of trading, so what goes on in our minds when the markets come up and down. So I'm excited.
Again, Dr. Elder's bio, he was born in Leningrad and grew up in Estonia, and I'll be in Estonia in a few weeks. We love Estonia. He entered medical school at the age of 16. At 23, while working as a ship's doctor, he jumped a Soviet ship in Africa and received political asylum in the United States. I'm afraid he's one of the guys that Trump is going to hunt down. But anyway, he's here. He worked as a psychiatrist in New York City and taught at Columbia University. But his true passion, his true gift is trading for a living. So welcome to the program, Dr. Elder.
Thank you very much. Pleasure to be here, as always. And, as I was listening to this wonderful introduction, I thought, gee, maybe I should buy my own book and read it.
Well, you are a legend, because when, Kim and I were working in Australia in the 90s, we'd always have people come to our courses, and they would say, well, that's not what Dr. Elder says. But we were doing the same thing, except Kim and I are more real estate investors because we like debt, which is leverage.
Yeah.
And I've done trading courses and all that. My brain doesn't operate as fast in that way. And I'm glad you're a psychiatrist, because wouldn't you say that most of investing is psychological?
That's right. Yogi Berra, the famous baseball coach who died just, about a week ago, used to say most of the game is 50% psychological or something like that.
Yeah, it's really funny.
It's all in the mind. It's all not all, but of course, but much of it is in the mind. the same stocks are being bought and sold all the time. There is not a lot of new stocks coming out. People are buying and selling the same stocks, and there are people who keep buying low and selling high, and then most people buy high and sell low. So it's really the psychological part, being able to analyze the markets and being able to be disciplined, that allows you to get on the right side of the thing.
Right. So, Dr. Eller, being a psychiatrist and all that, and I know you're going to Macau, one of our favorite. Kim and I just got back 2 days ago from Macau.
Lovely place.
Yeah, and I was in the casino. Now,
Yeah.
I do not sit at those tables.
Yeah.
And the reason is because I cannot control my fear of losing. Does that make sense to you?
It makes sense. It absolutely makes sense to me. I don't go. Well, I eat at the casinos, but I don't play at the casinos.
So we did.
But wouldn't you say, for a person like me and for the average investor, if they cannot control their psychology,
you've got to know what you know and what you don't know.
Right.
And most people, most people like to think that they know everything. They do psychological tests, and they say to a group of people, mark on a piece of paper how popular you are on a scale from 0 to 100. Most people mark somewhere between 70 and 90. People like to think more highly of themselves than they really are. And you having this ability to say, here is this thing which I don't control, I don't like, I don't feel comfortable with, and as a result, I'm going to stay away from it. Gambling, for example. Well, if you can say that, you're way ahead of the game. Being able to take sort of a positive decision about a negative situation seems simple, but it's actually a rare ability.
But wouldn't you say? How much of it is that fear? When I sit down at the blackjack table or the other table, I've had some really strange games in Macau. But my fear is so strong, it actually affects how I play the game.
And I've actually heard that the fear of losing is much greater than the gains of winning.
Kim, you're absolutely right. There is a beautiful book that came out, maybe 3-4 years ago, called Thinking Fast and Slow by Professor Daniel Kahneman, who won a Nobel Prize in behavioral economics. And it's a very deep and beautifully written book. And he quotes research after research after research that indicates, that proves from a scientific point of view, that the emotion of fear is about 3 times higher, stronger than the emotion of greed. So whatever greed, whatever acquisitiveness people have in them, fear is 3 times higher. You got to know those numbers, and you've got to do several things. You've got to respect your fear. And one way in which you respect your fear is by staying away from blackjack and whatnot. Another way to handle this is this, and I always recommend it to people who come to me complaining that they got hurt in trading, and they want to trade, they have all the knowledge, but they're afraid to put in a trade. What do I do? How do I control my fear? My advice to people like that always is, trade a small size. Reduce your trading to the size that makes no difference to you. In other words, if you buy 1 share of Apple, costs $110, and you put a protective stop, let's say at $95, your risk is $15. Are you going to be upset if you lose $15? No. Well, you can trade 1 share. Can you risk $30? Maybe. Okay, so then you can trade 2 shares. So the way I recommend to people to overcome fear is to sharply drop their size, really to the ankle level, and then slowly build it up. Slowly is the key word.
But that's one of the reasons I couldn't gamble in Macau, because the table limit was so high. It was frightening. I think it was, $40 a hand?
It was $40 a hand, yeah. And Dr. Elder, you couldn't put a protective stop.
Right.
So when you say protective stop, can you explain to our audience what you mean by that?
When a person, there is no protective stop in the casino, of course, but when a person trades stocks, and gives his or her broker an order to buy something, whether it's done on a voice line or on an electronic line. It's very easy, and actually it's highly advisable to put a protective stop. A protective stop is an order to sell that item if it goes against you by a certain amount or a certain percentage. And then you don't have to watch it during the day. You don't have to get nervous. You know right away what is your maximum loss on this thing. Of course, nobody likes to think about losses. We can be afraid of them, but we don't want to think about them. But having a protective stop frees you from having to watch it and to be anxious and to worry. And also what happens time and again with most people, they say, oh, it's going to go up. They buy it at 120. It's now down to 110. Well, that's okay. Maybe I'll buy some more. It's down to 100. Doesn't feel so good. Down to 80. Gee, that's unpleasant. When it comes back to 110, I'm selling. It's now 60. Oh, why didn't I sell at 80? It's now 40, and the person sells in a panic. And this is a very, very common scenario. And, of course, it goes to 38, reverses, and starts going back up again. The person is beating his or her head against the wall.
Have you been looking at my trading stuff, my trading documents? Hey, anyways, Robert Kiyosaki, we're talking to Dr. Alexander Elder, professional trader and author. He's also a medical doctor and a psychiatrist in New York City and taught at Columbia University, but his true passion is stock trading, and his book is called Trading for a Living. Came out in 1993. And we're talking to people who are so afraid of losing, they invest in the worst possible investments, mutual funds, ETFs, and they go long, hoping the market always goes up. So when we come back, we'll be talking to Dr. Elder, if you cannot control that fear, that possibly the most stupid thing you can do, especially in today's market, is to invest for the long term in stocks, bonds, and mutual funds and ETFs. But what Dr. Elder is talking about is we all have fear. The question is, what do we do with our fear, and how do we make sure we're not losers in the market?
Well, I want to find out from Dr. Elder. Dr. Elder, this market is kind of crazy. It's going up, it's going down, it's very volatile right now. How do you deal with this psychologically? How do you deal with this market?
Well, you've got to have a plan. You've got to know what you're doing. I'm trading in a fairly short term. I hold my trades a few days, rarely a few weeks. So for someone like myself, this is a very playing field. For somebody who is longer term oriented and doesn't watch it hour after hour, you've got to realize bull markets and bear markets come in cycles. An average cycle, an average post-war bull market, bear market cycle in the U.S. is approximately 4.5 years. Now, this bull market, pumped up by Fed's easy money, began in March of 2009, and it continued until this summer. So the bull market is 6 years old. It's way superannuated. And the bull is old, the bull is tired, and Mr. Bear is growling. So for somebody who is looking to get into the market, now about is the worst time to do it. If you're getting into it, if you're thinking of getting into it as a long-term trade, as a long-term investor in the markets.
What would you say to somebody though who drank the Kool-Aid from the financial planner, and say on average the stock market goes up 7 to 8% per year, and don't sell right now, just ride it out because markets always come back, and stay long or invest for the long term in stocks, bonds, mutual funds, and ETFs? As a professional investor, they're passive investors.
Yes.
As a professional investor, what do you think about that advice?
Well, it is a fact that the market, if you take a market over a 100-year period, it in fact rises approximately on the average over a century, which is longer than most people's longevity. It rises by 3% above the rate of inflation. So those are the numbers that any financial planner will rattle off. However, there are periods of time when the market way outruns the rate of inflation, which is what's been happening for the last 6 years. The market's been on a tear, and there have been periods where the market for decades stayed behind. The market hit, the 1929 high was not exceeded until 1950s. So, somebody who bought in 1929 and held for 30 years came out even, and somebody who held for 40 years actually came out ahead. But that's not the way humans operate.
So, but what would you say to somebody who drank the Kool-Aid, who actually believes their ETF or a fund of funds, which is buying the entire market, is going to protect them? Will it protect them?
I think ETFs and funds of funds are very, undesirable vehicles for an individual. Of course, if you create an ETF, which some of my friends have done, every time one of those chickens or turkeys or whatever other fowl trades that ETF, you get a small fee. So it's a wonderful thing to create. If you run a fund of funds, you collect a fee from the person who invested in that fund. Meanwhile, the person who invested in the fund of funds, he pays a fee to the guy who put him into fund of funds, and then he puts a fee to the individual funds where he is. So he gets two haircuts before he gets anywhere near any kind of profit.
So it's good if you own the fund, but you don't want to buy the fund.
Right.
So
but that's not the point, though. Will it protect them from a crash?
Oh, of course not. Of course not. Those things go. As a matter of fact, if there is a crash, or when there is a crash, we should say, ETFs are likely to go down much stronger than the overall market. I mean, that's what happened even now in September, August, September. We had a nasty drop in the stock market. It was the worst drop since 2011, and ETFs took the biggest hit of them all. There are a couple of ETFs which are not too bad, which were very broad ETFs. The SPY and the QQQ, those are ETFs of broad market indices. But all these more fancy ETFs, industry ETFs, country ETFs, they're bad. If you put two charts together, the broad market and the ETF, you will see that the ETF underperforms the market on the way up, and it really goes down much worse on the way down. ETFs are wonderful vehicles for those who create them, but I think as a general, the general public is being fleeced.
Yeah. So, Dr. Elder, you said that the bull is tired and the bear is growling. So if I'm invested in stocks, in individual stocks today, what should I be looking for? What should I be doing?
I would be shifting into gold. Gold looks extremely interesting at this point. The stock market is... as far as the stock market is concerned, I would be looking for special situations and special situations only.
What do you mean by special situations?
For example, drone stocks.
Drone?
Drone. You read about drone. Yeah. I don't mean the drones that are shooting rockets at bad guys, but I mean the estimate is that in the next within the next I believe it's 10 years. There will be a need for 100,000 drone operators. I mean, drones are going to do lots of different jobs, from emergency assistance to fire control to everything. And it's impossible to tell at this point which drone companies are going to come out as the next Apple or as the next Microsoft. But drone companies are the ones to watch. I mean, that's it. It just there is an industry which didn't exist a few years ago, and which is exploding. So, if somebody is going to buy stocks, you really have to not to do this kind of broad diversified market, but to really sit back and look at things. Look at the society, how it's changing, what is the big new change that is not yet widely recognized, and to go there.
Once again, it's Robert Kiyosaki, the Rich Dad Radio Show. Our guest today is Dr. Alexander Elder. His original book, Trading for a Living, came out in 1993, and is a new, revised, updated edition called New Trading for a Living, which came out in 2014. So for those of you who would like to better understand what Dr. Elder is talking about, He is a professional investor versus a passive investor. And most passive investors have drank the Kool-Aid of save money, invest for the long term in a well-diversified portfolio of stocks, bonds, mutual funds, ETFs. And that, at this time of the market, could be the worst possible advice ever. But you shouldn't just jump out of the fire, from the frying pan into the fire. So I would get his book, New Trading for a Living, to better understand what Dr. Elder does. His website is elder.com. Ladies and gentlemen, we are at a very precarious time in history. If you look at the Dow of the 30 stocks over the last 105 years, we have never been in a more dangerous position in the market. One more thing is happening, Dr. Elder, is that the thing called the 401k, which was designed for the baby boomers, came out approximately in 74, was activated in 1981. But in 2016, the first of baby boomers turned 70 and a half in 2016, and they must start exiting the market. So we have so many things operating as headwinds against the investors who drank the Kool-Aid and have gone long. So, one of the things I say is, don't go over your head. If you don't know what Dr. Elder is doing, they really shouldn't do what you do. Is that correct?
Robert, if I may cut in and say something about this Kool-Aid business. I'm not much of a Kool-Aid consumer myself.
Well, it's good for some people.
But for the last 6 years, it was a wonderful drink. Anybody who bought and held stocks within the last 6 years has done very well indeed.
Right.
The market makes a new high, buy. The market stages a pullback, buy. Basically, people who began buying in 2009, not too many of us did, but this whole melody of drink Kool-Aid, invest for the long term, diversified portfolio, it actually worked very, very nicely for the last 6 years, and that's why when you say drink Kool-Aid, of course I understand you mean it in a hugely negative way, but lots of people I would think are listening to you and saying, that Kool-Aid was pretty good for me, and I'm healthy and good, and give me another cup. What I think is hugely important, and I believe that's your message to your listeners, is that Kool-Aid is getting to be out of date. It was in date for several years, and it's getting severely and harshly out of date. And next stop is poisoning.
Right. And that's exactly what I'm saying. It worked for this time, but I wrote a book called Rich Dad's Prophecy, and I said the biggest crash. I wrote the book in 2000, said the biggest crash was coming in 2016. And for those of you who drank the Kool-Aid, like I said, and Kim and I were just in Macau a couple of days ago, listening to this young lady talking about how she wasn't worried about the markets because she went to a fund of funds. In other words, it's all that thing called diversification. Just keep diversifying, which means buy good and bad, and hopefully something good will happen. And that is passive investing. Most people are passive investing, and that works as long as the markets are going in your direction. My concern is, and millions of other people are concerned, we're about to hit a bear market. And our guest today is Dr. Alexander Elder, professional trader and author. His latest book is The New Trading for a Living, 2014. And I came across Dr. Elder's work out in Australia, where he has fanatic clubs that get together and they talk about trading and all this, because that's what it takes to be a professional at it. And so he's talking today for all of you who are passive investors who believe that, an ETF or a mutual fund will protect you in a crash because you're diversified, and worst of all, a fund of funds. That is very amateur thinking. So all you people with amateur thoughts, I want you to listen to what Dr. Elders has to say, and maybe, and it's not for everybody, you may want to shift from being passive or an amateur into professional, because the people that make the money are not amateurs. They are professionals make the money, and when the money markets go down, which we think it will, that's when the real money will be made. Unfortunately, the money will come from the amateurs. Any comments, Kim?
Yes, so Dr. Elder, so your new book is called The New Trading for a Living. We're talking about going from passive investors and active investors. So can you tell us specifically, what does it take to go from being a passive investor to an active investor? What kind of time commitment? What kind of education? What does somebody need to do to start to go make that transition?
Well, read his book, of course.
Well, start with the book, The New Trading for Living.
It's a great question. As a matter of fact, if somebody is interested in that, there is a much shorter and much cheaper book that I would recommend. You can get it on Kindle from Amazon. It's called To Trade or Not to Trade. Unfortunately, there was this British author, Shakespeare, who stole my title.
To trade or not to trade?
To trade or not to trade. But to answer your question, it takes a tremendous amount of desire, focus, commitment, time, and money. So desire, focus, commitment, you can't really quantify, but let's talk about time and money. How long will it take and how much it will cost? A reasonable guesstimate is that it will take approximately as much and cost approximately as much as getting a college degree.
Wow.
That's a lot.
It will take, I think, 4 years is a reasonable guesstimate. Some people are very good. They start making money during their second year. Some people take much longer. And by the way, a high degree of formal education is a negative. The more formal education you have, the harder it's going to be for you to learn to trade.
Well, that wasn't my problem, so anyway, I still have problems.
Why is that?
Because markets have a great deal of randomness in them. And somebody who has a very high degree of education believes that if only he spends enough time analyzing the markets, he will have the answer. For example, if you practice medicine and a patient comes in with a complaint, that patient deserves a diagnosis. You examine the patient. If you don't know what the problem is, you order more tests and then more tests. And if you still don't know the answer, you bring in a consultant. But you continue researching until that patient gets a diagnosis. But not in the markets. There are times when I look at the markets and it's a toss-up. It can go up or it can go down. The moments of clarity are not very frequent. And so one has to have the discipline, one has to have the knowledge to recognize clear times from unclear times and humility to stand aside while unclear times are upon us, and the courage to step in when clear times occur. And it sounds wonderful in theory, but it's not the easiest thing to implement. So one has to learn that, and that takes time. It also takes money because you've got to make lots of trades to become a trader, to learn how to trade. And if a beginning trader loses 10% in his first year of trading, I consider it a good result because most people lose a lot more. At the second stage, if you can match the rate on treasury bills, that's good. Finally, at the third stage, you start making real money. But just think about it. This is going to take several years, and this is going to cost money in the beginning.
But let me just say to the audience here is I believe in practicing what I preach. And back in the 90s, I did not only Dr. Elder's courses, but 2 other courses. And after like 6 days of learning how to trade, I realized my brain didn't have it. It wasn't really in my kind of DNA. I didn't enjoy it. Mm-hmm. So that's why I stay with real estate, and I've made fortunes in real estate, but I've been in real estate now for 40, 50 years.
Most people cannot do what you're doing right now. Most people cannot say, I don't know.
Yeah, I don't know.
It's a rare skill. It's really a rare skill. I got a first example. I got sort of first time impressed by somebody who had that skill. My mother took me shopping for a watch back in the Soviet Union, where a good watch was just unavailable. But she was a physician who specialized in venereal diseases, so she treated all the shop girls. And so a watch was produced from under the counter.
And
the girl proceeded to describe what a wonderful watch it was. And then she says, we have a machine that you can listen to this watch, how wonderfully it sounds. And my mother said, if you give me a patient and a stethoscope, I can listen to the patient's heart and lungs, and I will tell you what it means. But I don't know how to evaluate the sounds of a watch. If you tell me it's good, it's good. And I just stood there and said, wow, here was a lesson for me. Here was a person who was clearly highly competent and at the same time knew her boundaries, knew what, that's what you're doing right now.
Right. And that's why I make so much money. And a lot of people want to jump in when when real estate market's going up, and they generally get hammered when it goes down. When you say that, it does. What I'm saying, it doesn't make a difference what asset class you invest in, but the question is, are you willing to dedicate yourself? Isn't that the statement?
Absolutely. You have passion for real estate, and because of that passion, you don't count hours that you're going to spend researching a property, or the effort that you're going to have to make to raise the capital to buy a property. It's a labor of love.
But also it becomes instinctive. Wouldn't you say that there's a part of it that the fear is gone. It goes into, I know, this one is going to, I suspect this is going to be a good one.
Same thing in trading.
Yeah.
People say to me, what about gut feel in trading? And I say, well, you earn your right to the gut feel.
Right.
Yeah.
If a beginning trader has a gut feel, he should probably lie down and wait until the feeling passes, because it's probably something bad that he ate.
So before we,
it does go back. It does go back to what you said earlier. Desire. The first thing is the desire. It's what you're talking about, Robert.
Yeah, but also the main message of this program for those of you who are thinking that diversifying, going to ETFs and fund of funds, this might be the worst time to do it, and you have a choice. You can either do that or you can learn to become a professional, because it's going to be a good time because of volatility. But the question is, I have for you, as you mentioned earlier, you think gold is an interesting position right now. And we have a lot of gold bugs up there. And the reason I like gold, it's pretty simple to either buy it or sell it. And that's about it, right?
Yeah. I went to all those conferences and events when gold crossed above $1,000 an ounce, saying to anybody who would listen, that gold crossing above $1,000 an ounce was like when the Dow crossed above 1,000. 1,000 in the Dow was called the graveyard in the sky. Dow would go up to 1,060 and have a bear market. Once Dow decisively crossed 1,000 points, we were in a new era, a new stage. So gold, it happened with gold above 1,000. It had a fantastic bull market. And, of course, everybody fell in love with it as gold was approaching 2,000. I believe the high was 1,900 and change per ounce. Now, that was the place where everybody was happily buying gold. Was pretty clear that the top was at hand to me. The gold came down, and the gold almost reached 1,000 again. It came below, it came to $1,100 an ounce. And that's where nobody likes gold. No, except for some, old-timers, hardline old-timers. Gold is not a popular investment anymore. But meanwhile, what happens was this: the bull market retraced almost 50%. It refused to come below that extremely important line of $1,000 an ounce. And it's now turning up, and it's been going up very nicely for the last couple of months. I look at my computer screen, and all the technical indicators that I use are saying, we have a bottom, we have a bottom, we have a bottom.
Once again, it's Robert Kiyosaki. We're talking to Dr. Alexander Elder. The theme of this show is that for the average or the passive investor of a mutual funds and ETFs and 401ks and all that, going long or buying and holding and praying could be the worst advice at this time, because I got a bad feeling in my gut. I think it's going to reverse down and go into a bear market. So our guest today is Dr. Alexander. He is the author of The New Trading for a Living. Dr. Elder was born in Leningrad, grew up in Estonia, where Kim and I are going in a few days. And he he was a medical doctor. He left the ship the Soviet ship in Africa, and received a political asylum in the United States. He's worked as a psychiatrist in New York City and taught at Columbia University, but he is most well known for his teaching people to trade. How does a person, before they get to that level, how would you say they could, let's say they buy your book, The New Trading for a Living, do you teach courses all over the world?
I do something better than that. I teach courses occasionally, but what I do is I run a group of traders together with a good friend and a business partner of mine, Kerry Lavon, in Alabama. We run this group called Spike Trade, where people submit their favorite picks on a weekly basis. And we're the only group that actually pays people for performance. We run a weekly competition, friendly competition, where people give each other advice and share ideas. But people win bonuses, and including cash bonuses at the end of the quarter for the top performers. So that's where people really hang out with other traders and learn from each other.
How do they get in touch with you on that program?
Just type in Spike Trade. Spike like a railroad spike.
SPIKE.
SpikeTrade.com.
So, Dr. Elder, does China have an impact on the markets? What's your take on that?
Well, China just blew up a bubble. I mean, Chinese market is amusing to me beyond belief. It stays asleep for about 4 or 5 years, then it blows up a bubble much faster and much bigger than we do here. And then the bubble goes pop, and for the next 5 years again, we don't hear from Chinese market again. So their bubble just blew up, and I don't think it's finished blowing yet. I think it wants to go further down, and then peace and quiet. Call me back in 4 years.
But for you, that's neither good news or bad news, because you'll trade it.
I don't trade there. You know, to me, when you trade, you try to take money out of another person's pocket. That's really what you're trying to do. Meanwhile, paying commissions and whatnot, and that person is trying to pick your pockets. So it's a tough game. And it's hard enough to do it while I am awake. Why would I want to play this game while I'm sleeping? I'm asleep and some Chinese trader is putting hands. You know, it just doesn't work this way.
So once again, I want to thank you very much for your time. You're always a welcome guest here, and
thank you.
We'll check back in with you when the market does more of its gyrations.
And we're going to look into those drones.
That's right. So now we come to the most popular part of our program. It's called Ask Robert. It's where you get to ask your questions. Before I go to any comments, Kim?
Yeah, I just wanted to say, Dr. Elder also has a book you can find online called To Trade or Not to Trade. And because I find it really interesting, he says the bear is tired. He says the bull is tired and the bear is growling. So I think the big takeaway from this show is if you are in the stock market today, what are you going to do about that?
Yeah, if you drank the Kool-Aid of investing for the long term in stocks, bonds, mutual funds, and ETFs, you're in trouble. That's what I'm trying to say to you. And this thing is called a fund of funds. All they are is an underlying statement called diversification or de-worsification.
And he said that, Dr. Elder said that if the market comes down, those funds of funds, those mutual funds, those ETFs do worse than
they'll accelerate down because they did well going up.
Right.
So for those of you right now whose future depends upon your investment portfolio, I would really consider getting the new Trading for a Living and read about the possibility of trading, because it's your future.
It's your money.
It's your money. First question, Melissa, from Ask Robert.
Our first question today comes from Bianca in Houston. Favorite book, Rich Dad, Poor Dad. It says, what would a global depression in the USA look like?
By the way, if you have a question, please submit it to AskRobert@richdadradio.com, because we love to hear what's on your mind. So please submit your questions at richdadradio.com.
I just talk about the global depression because I don't think you really have to look at it globally. It depends upon you right now. There's people today who are in depression. You know, they've been hammered. They're out of money. I meet them every single day. They go, oh, what can I do? You know, I lost my job. I don't have any money. They're in depression. So depression is really a case-by-case event. So I wouldn't really worry too much about a global depression. All I'm trying to say to you is what Dr. Ellis is saying. It doesn't make any difference, because when things come down, there's actually more opportunity. So I'm paying attention to how markets are swinging right now. Dr. Elder talked about gold. It might be the best opportunity if markets crash. So all of this stuff here is there's no such thing as a global depression. There's only individual depression. That's how we hold it. And all of you out there in your stocks, bonds, mutual funds, ETFs, and funds of funds, you might be depressed soon if you don't pay attention. Next question, Melissa.
Our next question comes from Leon in Bogota, Colombia. Favorite book, Rich Dad, Poor Dad. He says, I'm having trouble understanding the surge in the value of the U.S. dollar. If the Fed is printing trillions of dollars, common sense would lead someone to believe that the increase in supply would cause the value of the dollar to fall, not rise. Why is this happening?
Well, that's a very tough question. That's a good question, but a tough one. There's a book called The Dollar Crisis by Richard Duncan. and also the New Depression by Richard Duncan. I'd read that book, but to explain the dollar is tough. Right now, the dollar is the last currency standing because it's the dollar that actually caused this biggest problem. See, back in 1944, a thing called the Bretton Woods Agreement made the dollar the new gold standard. So it went from the gold standard to the dollar standard, and then in 1971, Nixon took us off the gold standard, and now the dollar is spreading all over the world. So the dollars are running home right now because they're getting out of emerging markets in China. So what that means is America probably will go into a next boom because dollars will be flowing into America, but all booms are followed by a bust. And that's what's really frightening right now because China just went bust. That means the United States is going to boom and then bust. That's my prediction.
And I love what our Rich Dad advisor, Andy Tanner, says about it because most markets have been printing money, right? Most countries have been printing. Most countries have been printing money. So he says, so the U.S. dollar is just the least ugly contestant in the beauty contest, right? They're all in trouble, but the U.S. is less in trouble than the others.
The reason they're printing money is they're trying to prevent a depression, and unfortunately, it'll keep going until people realize the hoax, and that's when we go into depression. When people stop accepting dollars, we're in big trouble. But it's also a good time to buy gold. See, that's how you look at stuff. Next question, Melissa.
Our next question comes from Chad in Alberta, Canada. Favorite book, Unfair Advantage. He said, there's so much happening in the world right now. Fear-mongering is everywhere you look. With all the different markets fluctuating and threats of recessions in different countries, how does one get started in getting out of the rat race and, more importantly, stay focused on achieving their goals?
The biggest thing is that's a good question, but look at it from the bigger picture. When this market comes down, you'll have more opportunity. That's the way I look at it. Now, what opportunity? I don't know. But if I let my fear get to me, then I've had it. And that's why we started this thing with, Kim and I were just in Macau where Dr. Elder is going this week. The reason I don't play blackjack is I really don't want to learn to control my fear playing blackjack because I don't have any control of that game. And also I don't trade like Dr. Elder does because I don't really have the brain for trading. I have a real estate brain. Now, when markets crashed in 2007, Kim and I made fortunes because the best real estate in the world went down. That's really a good time. But if you've drank the Kool-Aid that markets have to keep going up or depressions are bad, you'll never see opportunities. So it really is your mindset that this is a great time to get rich, regardless if it's up or down.
And you might want to re-listen to this show because Dr. Elder talked a lot about fear and how you manage that fear. And the one thing he said, which we say at Rich Dad also, is if you're starting and you want to get out of the rat race, you take small steps.
The big thing here is Kim and I were just coming in from Hong Kong, and this young guy came up to me and says, I'd like to do what you do, but I can't afford it. And that's where it starts.
Yes.
The moment you say you can't afford it, you're finished. Because Dr. Ellis is going to take 4 years and money. Same as real estate. Now, the moment you say you can't afford it, that means you have a loser, you have a poor man's or poor person's mentality. As they say in the Bible, the word becomes flesh. If you say you can't afford it, you're a very, very poor person.
And if you're saying I can't afford it, aren't you saying I'm afraid of losing?
No.
No? I would think that I can't afford it means I'm not going to make any money. So
that means they're not in control of their life. They're not in control of their thoughts, number one. You've got to stop the thought. You can't control your thought, and you can't control your mouth. You can't control your emotions, and you can't control your spirit. You really should not do anything we're talking about because you're not in control of your frickin' brain. Your mind is your worst enemy. If your mind is saying, oh, I can't do this, I can't do that, or the rich are this, if you can't control that, you can't control your life. And that's really the problem. Next question, Melissa.
Our next question comes from Raj in India. Favorite book, Unfair Advantage. He says, I'm currently buying and writing options, credit spread leaps in the U.S. market. What will be the impact of the two giants failing on the options market? I feel despite any failure, some specific option strategies will always produce good returns because of their covered nature. What is your opinion on this?
Well, 99% of the people have no idea what you just talked about.
That's right. Not a clue. Yeah. Leaps, options.
I understand what you're saying, but I would say just say to you, very smart young man, because right now you should be doing what you're doing, getting, as Dr. Elder says, your practice in. Like what happened for me, because I did Dr. Elder's courses and other people's courses, in May of 2015, Kim and I exited the stock market entirely because we knew it was over. Now, at the same time, I'm coming back in, and because I took Dr. Elder's courses, what we're doing is we're running naked puts. Now, the average person goes, what the hell is a naked put? Well, that means I'm selling something I don't have. And the average guy goes, you
How
can't
do you do that?
And that's why you should take the course, especially the people who say, well, I can't afford it. Because your brain you program your brain, or your mommy and daddy did, or somebody program your brain to be a poor person. Writing a naked put means I'm selling somebody insurance on a stock I don't have, and I make money. It's called cash flow. That's what Andy Tanner teaches. But it begins with vocabulary. If you don't understand what that young man said or what a naked put means, then you're really missing out on fabulous opportunities. And that's why we have this Rich Dad program, because it doesn't make any difference, because the biggest gap is between your ears, your left ear and your right ear. Because if you don't take control of what's going on between that and put in information and data and education that you want, then you're going to be the biggest loser of all.
And I think Raj, I think you're exactly right. Raj is in a great position because if these markets come crashing down, he's already educating himself. He's already getting the experience of these options and how to take advantage of when the markets come down. I think that's really smart.
You'll make more money when markets come down.
Yeah.
That's really the fact. Remember, for Kim and I, 2007 was,
Good year.
thank God, it was fantastic.
Good year.
We made millions and millions of dollars. And every time they drop interest rates, we make even more money because the cost of our debt goes down. That means more money goes into our pocket. Now, if you don't understand that stuff, you're in very big trouble. That's why we had the Rich Dad radio program. We don't give you advice except that we recommend you study, learn the vocabulary of money,